All right, welcome everybody to what I believe is our 20th webinar. It's Holmquist and Gardner, obviously a law firm doing business in real estate law. Being reminded this is the 19th webinar. Let's not get ahead of ourselves. Can't believe we've been doing this that long. We are a law firm focused in business and real estate issues, and obviously founded in 2008. So we've been at it a while and excited to have both a litigation team and a transactions team. And so today's presentation is squarely in the middle of what we do on a daily basis. Just a reminder, these webinars are available on YouTube. That's really exciting. I can't believe that I'm saying that out loud, that we have a YouTube channel, but there it is. We also have this on our website. So later on, this will be recorded and a link will be sent out so that you can share this with your friends, colleagues, and make sure that the value is being added to them. As we go through this, you should know that we are doing this for informational purposes only. Of course, anything that you hear should be run by your own insurance advisor or your own attorney. You should not take anything in this webinar as legal advice. This is part one of our series on key issues in insurance, particularly commercial insurance. We will be doing a second second webinar with Melody in January, talking just about cyber insurance and cyber liability issues that are out there. But today, we are very glad to be joined by Melody Olson. Melody's worked in the insurance industry for the past 17 years. Most recently, Melody was with Parker Smith and Feek for 11 years, and now she's at Propel as a regional director. She's got a real strength in real estate and construction with an emphasis on project risk. And we're just very excited, especially to have Melody on because she's a fellow Husky. You can tell by our logo color choice for the firm that we bleed purple around here. So that's great. But also we lean very heavily on Melody and other folks in the insurance world as advisors. So many issues come up in our construction and real estate transactions where we just don't know. And we're very happy to say, look, we don't know, there are experts out there. Have you checked with your insurance advisor? Melody is one of those advisors we trust. So we're delighted to have her sort of walk us through an overview of the types of insurance we typically see policy-wise, builder's risk, OCIP, RAP, CGL, talk about a traditional insurance application approach versus the modern approach, and then trends to keep in mind. And with that, I'll be joining along for the discussion. Again, Melody's the expert. We'd like you to keep your questions coming as we go through, and we're happy to stop and answer those. So just click the Q&A button, use Zoom to leave us a question so that we're not bogged down totally at the end. We will have a question and answer period at the end to go through anything we don't cover, but feel free to just to type in a question and we'll try to address it. With that, Melody, thanks for joining us.
Thanks, Imants. I'm happy to be joining you, actually excited. You know, insurance can be a topic that most try to shy away from, right? It seems boring, but I'm excited to present to you on project risk insurance today because I feel like it's the Wild West of insurance, right? I mean, it's just, it really gets the creative juices going. No projects are, you know, one and the same. And these products really allow you to tailor specific insurance coverages and nuances around the specific project. And so with that, I mean, that's what keeps me going every day, and love to just present this to you. So can we go to the slide? Perfect. All right, so really going to talk about a lot of the basics of project risk, right? When any developer is starting to look at insuring the construction of a project, there are general kind of table stakes, general liability. So whether that be under a RAP, a project specific type policy, or the traditional insurance brought by the general contractor and subcontractors, the pollution exposure and how you cover that. And there's various ways that we'll talk about. Builder's risk. Now it's always funny. Everybody likes to use builder's risk as a synonym to general liability coverage. And really, when you think about it, it just says, oh, it's risk, it's liability. And it's actually the opposite. Builder's risk is property coverage during the course of construction. And so we'll dive a little bit into that piece, as well as pollution legal liability and some considerations and trends that we've seen with owners and developers of finding dirty dirt during excavation. Next slide, please. All right, so from a general liability standpoint, there are a couple approaches to a project. You can have the traditional approach of the general contractor bringing their general liability program, the subcontractors bringing their own general liability insurance to the table, and then the owner having some supplemental general liability insurance for their vicarious liability for the land during construction. For, 50 plus years, the traditional approach has been used. And I would say over the past 10 years, some alternatives to that traditional approach have been becoming really popular amongst owners and developers for a lot of different reasons. I'd like to just say general liability coverage is really third-party bodily injury or property damage during construction. So think of, essentially somebody slipping and falling on the project, somebody that's a third party, somebody from the public, or issues caused to neighboring sites. Something falls off the project and damages a neighboring building. So that would be, bodily injury, somebody getting injured, or somebody damaging some third party property. And then there's another component to general liability coverage, which is completed operations, which a lot of people like to liken it to construction defect coverage. So post completion of the project, there's a defect or a statute within Washington of 6 years. And so with the general liability, we like to think of it as GL during construction and then post completion defect coverage. So what is an OCIP or CSIP or a RAP? They're all used interchangeably, and they're an alternative to that traditional approach that we spoke about. Really, it's a project-specific general liability policy. So it's a policy placed and underwritten to the project, and it covers the owner, the general contractor, and all enrolled subcontractors on site. So I guess, the owner would place it at a whatever desired limit, and that everybody else is comfortable with, whether it be the general contractor or sub. And that tower of limit is dedicated to the project during construction and post completion. So, we like to say it's kind of that guaranteed statute coverage. In a traditional approach, the general contractor and the subcontractors bring their insurance during construction, and the owner relies upon that general contractor and on all subcontractors to continue to renew their insurance post-completion for that defect period of 6 years post-completion. With the OCIP, CSIP, or sometimes it's called a RAP policy, depending on who's sponsoring it, you say OCIP, owner controlled insurance program, or CSIP, contractor controlled insurance program, that bakes in that defect coverage and has certainty with that dedicated limit. Next slide. All right, so a lot of people are like, why are they so popular? Why RAP policies? And there's various reasons, and depending on who you talk to, you will probably have some different answers. But if we boiled it down, I liken it to about 6 or 7 different reasons that I hear most common. So over the past 10 years, a lot of subcontractors have had residential limitations in their policies, saying, hey, you can't work on multifamily work, or you can't work on townhomes or single family tracts, or we're going to limit how many unit counts you can work on. And that's really just a reaction from a lot of the insurance carriers in the area who just said, hey, we got hammered in apartment work and we're no longer writing subcontractors that do that, or subcontractors that write or that do like 10% or less. And we're going to limit the unit count there. And so what we found is a lot of subcontractors had questionable residential coverage. And with the amount of multifamily going up in the Seattle area and really just up and down the I-5 corridor on the West Coast, that has begun to be a bit of a problem. There's coverage advantages to a wrap. You have everybody under one policy and you are rating off of that entire project, which puts a lot of weight into premium for a carrier, where you can oftentimes negotiate additional coverage enhancements that wouldn't be available on an individual policy brought by a subcontractor or the general contractor. There's lender requirements, and we love our lenders, but oftentimes they have some onerous requirements that say, hey, we want this size of limit. We want the subs to carry this limit, or we want the owner to carry defect coverage in addition to what the general contractor is bringing. And then it becomes kind of a cost play of, well, the cost for the owner to get a project specific policy for the course of construction and, post completion, along with the GC bringing their own coverage. Kind of just makes sense to bundle it under a wrap and share that limit and get the economies of scale within that premium. Another thing is, project scale, right? I mean, the larger the project is, it's kind of an inverse relationship with rate. And so oftentimes you see that the rates would be cheaper than all of the pass-throughs from the subcontractors and general contractors. And you definitely see that above projects that are above about 100 million in hard costs. Along those lines, owners or contractors, depending if it's an owner-controlled insurance program or a contractor-controlled insurance program, there's a recovery of insurance credits or bid credits. And sometimes you can see that there's a cost avoidance factor by putting a wrap into place, or OCIP or CSIP. You can have essentially GL insurance avoidance because the subcontractors and the general contractor aren't loading their cost of GL insurance into their bid. And sometimes that subsidizes the cost of the OCIP. I think one of the big factors, that most owners or generals can see is if there's ever a claim, there's one throat to choke, right? There's one carrier and the excess carriers, if it's a large tower, that responds to the claim. I don't know if anybody's been involved in any type of claims during construction or post-completion where we're not sure which sub caused the damage, or maybe several subcontractors had contributory factors to causing the loss. And you see a lot of carriers getting the claim and then pointing fingers saying it was this sub or that sub, or maybe it was the GC. And so sometimes you see that where, it's a really streamlined process with a wrap because it's one carrier adjusting the claims and they're on the hook, whether it was this sub or that sub, because everybody's combined under one policy. And then, as I mentioned before, the guaranteed statute.
Yeah, I would just add here on the wrap side that when you have that one carrier, you avoid egregious eliminations or exclusions from coverage with multiple carriers, multiple policies. You have them saying it's just an excluded claim. If you've gone through the process to get a wrap with someone like Melody or insurance advisor, typically you've looked at everything and decided what the best coverage is, and you've reduced your risk of just complete exclusion or finger pointing.
Absolutely. Next slide. All right. So I get this question a lot, especially from my construction clients of, okay, there's a wrap on this policy and we just found out about it and we're going to have to enroll. What do we do? And I think, the best advice from an insurance broker standpoint is, okay, well, let's talk about some of the table stakes or points of negotiations with a wrap, whether you're a general or a subcontractor. Because wraps are the Wild West, no two are alike in their administration as well as their terms and conditions. So with that, it's really, really important to look at the wrap manual. And it's a manual that I'll outline all the coverage, all of the limits, the deductibles, and then how are we allocating those deductibles? So when I look at a wrap manual on behalf of my contractors and subs, I definitely go straight to the deductible allocation, because that is at the discretion of the sponsor of the policy, whether it's the owner or the contractor, OCIP or a CSIP. And oftentimes you see that owners like to have the general and the subcontractors have some skin in the game. And to what extent? You know, a general baseline deductible these days in the wrap market is about $50,000 per claim. And so you'll see the owner try to pass, you know, $10,000, $25,000 to the general contractor, and then have some terms of what the subcontractor's responsibility would be based on their alleged contribution to a claim. So we always go there. You always want to know what you're signing up for as a sub or a GC. But the next point is going to, okay, well, because this program replaces the general liability coverage for any subcontractor or general contractor, you want to make sure that you have adequate limits for the project, because their traditional policies or annual policies will have a wrap exclusion. So basically that policy that they purchase every year will not apply to a project in which it has a wrap. And so the wrap becomes your insurance for that project. And so you darn well want to make sure that the limits are adequate for the size and scope of project, because everybody's sharing it. Another thing is quality of coverage. Are there any limitations or exclusions buried into the wrap program that we would want to be aware of, or see if they can be removed? Because again, it's everybody's coverage. There's some enrollment conditions as far as, you know, what offsite limits you carry, and if there are, you know, certain guidelines on their pollution limits, as well as auto, all of that. So we just kind of like to look at, well, does the rest of our program outside of the GL satisfy what the wrap is asking for, so I can enroll in it? The bid methodology is another key factor. Are they asking the subcontractors to bid net of insurance? And in that case, okay, don't include your insurance costs or your GL insurance costs in your bid. But some wrap policies, or the owner or contractor, depending on who's sponsoring it, like to chase bid credits. So they'll say, hey, subcontractor, bid with your insurance, and then we will verify what your rates are later via the wrap administrator, and do a deductive change order for that insurance cost. So that's always a surprise for some subs that aren't familiar with wraps, or it's their first one. So you really want to look at, well, what's the bid methodology, and did I bid it correctly in congruence with the wrap? The other factor is rolling wraps have become quite popular, especially with owners, developers, or general contractors that have a large pipeline of business. And so instead of just, you know, putting all of their projects under their annual program, they'll have a roller or a subscription policy where they will place a wrap for every project, but they have pre-negotiated rates on the back end and a commitment with said carriers. And so that gives additional economies of scale. But in some rolling programs, they share limits across projects, and they don't have dedicated limits. So that's a factor when you're wanting to look into enrolling a wrap of, is this a rolling program? And if so, what are the terms of that? And is the exposure spread across other projects? Next slide, please. Perfect. All right. So there's a lot of nuances to wrap policies. We could talk about them all day, but we definitely covered some of the basics and table stakes there. So with that, we'll transition to pollution wrap if there's no questions already. I don't see any yet. So So pollution wraps have become quite popular, and similar to a wrap policy, a GL wrap policy, you can place a single policy that covers the owner, the general contractor, and all subcontractors on a project for pollution exposures. It's typically purchased by the owner, not as much by the general contractor. And you share that tower of limit, and it guarantees that there's pollution coverage for everybody working on site. I'd probably say the most common pollution claim that we see in the Pacific Northwest are mold issues, mainly from water intrusion. And so mold and fungus are excluded under general liability programs. So it's important to have some type of pollution coverage, especially if there's subs that are more prone to those types of exposures with water intrusion, if you're not going to go a pollution wrap angle. But the pollution wraps have been pretty aggressively priced as of late, and you can't really beat the coverage terms and conditions because you're rolling everybody's exposure into one. That also has the guaranteed statute coverage post-completion. So again, it's baked in, it's certainty. And what I like about pollution wraps is there's no enrollment conditions. So basically, just if you're doing work on the project and then you're automatically qualified for the wrap, you don't have to enroll and have a third party administer that enrollment process. Next slide, please. Builder's risk, yay, love this one. So builder's risk is property coverage during the course of construction. And really it's covering the total hard costs on the project, the recurring soft costs on a project. So if you had a loss, what would you recur from a soft cost standpoint of re-permitting and architectural and design fees and things of that nature, loan carrying costs, all that fun stuff. And then loss of rents or delay coverage. And that can be purchased on a 12 or 18-month basis generally. So all of that is kind of baked in, and the hope is, you know, there are no losses, there are no thefts of materials, there are no fires. If it's frame construction, it's even worse. But really it's just, it's sticks and bricks coverage, and then all the ancillary or indirect costs that are associated with any damage to the sticks and bricks. So, you know, when we're looking and evaluating builder's risk insurance, obviously the insured values are really, you know, kind of the most important piece to it, but it's also kind of what is also thrown into the policy, like offsite storage and transit limits, making sure that those are adequate, especially for larger projects, or, you know, what we're seeing sometimes is developers buying lumber in bulk because of the change in price. Now we're seeing that on the steel side, making sure that we have enough offsite storage or transit limits to cover materials in storage and transit. And I think one of the most pertinent factors of a builder's risk policy is making sure that it not just covers the owner, but it also covers the general and the subcontractors of every tier. The general and subs might have interest in the material if there were a loss or theft or fire, something of that nature. But the other piece, and Imants will definitely agree with me, is if there is a loss, being a named insured on the policy as an owner or general contractor negates the builder's risk carrier's ability to subrogate against the general liability policy of the GC and subs. Now, oftentimes you hope there's a waiver of subrogation in the owner GC contract that passes down and trickles down through to the subs, but being a named insured on the policy, they can't chase their own policyholder. And therefore we like to have that kind of backstop to coverage. So the loss ends at the builder's risk carrier and they're not trying to find money elsewhere. And Imants, I know that we've talked about that in the past. And
yeah, this comes up frequently.
Gotcha. Yeah. And then so the adequate contractual waiver of subrogation is another important piece when speaking about builder's risk policies. So
yeah,
what are
waiver of subrogation issue is one that spreads across pretty much all insurance issues. If you're a landlord in a commercial lease setting, it's difficult language to read because you're like, wait a second, no claims. And then you're like, oh, I get it. We're all paying for insurance here. We don't want to be following up with further litigation we were all trying to avoid.
Yeah. Yeah, carriers, they don't like to, everybody hates to pay a claim on the carrier side, but if they can have any sense of chasing somebody else for reimbursement, they try. So making sure, yeah. So some of the trends in the builder's risk market, I think the biggest pain point for developers and general contractors is frame construction. We have a lot of it in the Pacific Northwest, and the frame construction builders risk markets have been hit very, very hard nationally with claims. And what happens there is they pass that along to the consumer, and it's passed through high rates and reducing their capacity, which also reduces leverage. And then now it's a seller's market on the builder's risk side. So frame construction has seen probably a doubling in rate over the past 3 years. And it's pretty scary. And I don't really see that minimizing over in 2022 as well. I think it actually gets a little worse, because not only are the rates going up and you have to have more carriers participating just to put up the same limit that probably would have been achieved by 1 or 2 carriers 3+ years ago. Now you have 6 or 7 participating, because they don't have enough capacity to say, I'm going to give you 10 million on this project. Now they're only going to give 5. So with larger frame projects, it becomes a really difficult task to build enough capacity and then also get the aggressive rate from those carriers, because they're really holding the bag on the rates. Site security wise, we're seeing that become more stringent, especially with frame construction. Not only is it costing more, and there's more carriers involved, now they're saying, hey, we want stringent site security, whether that be camera monitoring, as well as fence locked and lit, and then also heat and smoke sensors. And there's a lot of different systems out there. I'm sure everybody's kind of heard of a Fedora system or something similar like that. And some are even requiring 24-hour watchmen, which can be a costly thing on a project, because if it's a 2-year build and you have a 24-hour watchman, sometimes that can be 100, 150 grand a year, just having eyes out there all day, every day. We're also seeing a lot of carriers incur losses for water damage, especially with more of the high-rise construction or more than 4 or 5 floors. So during construction, if there is a leak and it goes undetected, all of a sudden that water damage loss becomes very large to a builder's risk carrier. So they're looking to the owner or general contractor, depending on who's placing the builder's risk policy, to have more skin in the game for water damage. It's not uncommon to see a water damage deductible of 150,000, and then having kind of the all other perils deductible be 25,000. So there's definitely increasing and on the rise. I think the other point to talk with builder's risk, especially with frame construction, is extensions. Most projects, due to one reason or another, COVID being one, there's been some delays in completion. And so the builder's risk policy placed 18 months ago, we thought we were going to be done by now. And then, come to find out we have some delays. And so we need to extend that policy. And given the condition, especially of the frame market, those carriers are now saying, hey, we're no longer writing frame, so we're not going to provide you an extension, or that extension is going to cost a lot more than what the initial base policy rate costs. And so that can be a terrible scenario to be in, especially if some of those carriers exited the market, because any new carrier that you bring in for that 3-month extension is going to charge as if they were on the project the entire time, because you're asking them to jump on the exposure when it's at its most, right, towards near completion, and they didn't collect premium during that time when there was the least amount of exposure during construction. And so I'm not advocating for them, but that's their rationale, and it can be a sticky situation when it comes to extensions. So making sure that you're getting that policy term right up front, or at least adding some padding for delay, especially if it's frame construction, is something that we are often advising our clients. Next slide, please. And finally, pollution legal liability. I think more popular over the past 5 years. Oftentimes it's a lender-driven request, or the owner developer is more concerned about the site conditions. So in Seattle, even in Bellevue for that matter, you can be digging and excavating and shoring and find some contaminants, some dirty dirt. Sometimes you bump into an underground storage tank you didn't know was there, and that storage tank is leaking as well. So before you start the project, you can buy a pollution legal liability policy, and basically it's covering for those unknown conditions that you never found in a phase 1. We didn't know it was contaminated, but we found contaminants. This pollution policy will pick up your first party coverage, so cleanup and disposal costs of the contaminants, as well as any liability that you have for any migration to neighboring sites. So, it's very common to have pollution legal on the East Coast, just because, it's inhabited a lot longer potentially. So there's more, you're more susceptible to finding dirty dirt. But I have to say, even just in the past couple of years, we have seen some claims in the 6 and 7 figures for, gosh, we found things under there that we didn't know were there. And it costs a lot to clean up and dispose of it correctly.
Yeah, this is something that we're definitely moving trend-wise into advising clients to look into and obtain. Some lenders require it, but it's definitely a piece where the increase in claims, the increase in rigidity of the Department of Ecology, it seems like you used to be able to get a no further action letter and things were easy, and now, well, not easy, but now this has become a more common type of coverage to look out for.
Absolutely. And if you have a clean slate phase 1 and there was no reason to have a phase 2, compared to the cost of, what a claim is, or the disposal and cleanup, it's fairly inexpensive to purchase on the front end. The policy does not cover known conditions, right? If you know it's dirty dirt, it's not going to pick that up. It doesn't cover intentional acts or any known underground storage tanks. So it's just new stuff that we didn't know about.
All right, this moves us to our Melody, unless you had some other things to add on there at the end. We've got a series of questions to go through, half of which are mine.
Yeah, absolutely.
The first one we have, and if anyone out there has more questions, keep them coming. I'll just read off the ones we can get to. You mentioned some things the carriers ask builders to do as a part of the policy requirements. Do you do any consulting to potential clients up front before you quote a policy to help find ways for them to save up front? For example, if you do these 3 things, we can get you into a lower premium or a lower risk category.
Yeah. I think especially when it comes to builder's risk, because that's one of the larger line items for the owner or developer, consulting with them on what the site security requirements will be up front and when they're installed is an aspect that can save money, right? If we're just digging and there's no exposure to materials, we don't have to really put up a lot of site security and cameras and motion sensoring and paying those, monthly costs, right? We can wait till we're going vertical and negotiate with the carrier of, hey, there's no exposure, therefore, why don't we put these site security requirements up when there is an exposure. And so oftentimes that can save 3-6 months of those carrying costs from installation and continued monitoring. I think the other piece, and it sounds boring, but especially with builders risk policies, is going through their soft cost budget and really identifying what the recurring soft cost would be. So what you would actually recur in a loss versus insuring to the full limits. That obviously reduces your rateable exposure and therefore it reduces your overall premium. So those are some tips and tricks there. Definitely something to consider. On the liability side, from a wrap perspective, especially with more sizable projects, you can certainly look at what that bid methodology is and consult about, well, if we went and retrieved bid credits via deductive change order, what would we quantify those costs to be? And we have some parameters to go through that versus having everybody bid net and worrying about kind of, are those insurance costs somewhere else in the bid? So there's some factors there, but depending on kind of who we're representing and who's placing the policy, there's tips and tricks on each side of the house.
Absolutely, and I think it's very project dependent. Each project seems to come, there's new issues and every project's unique. I think that's probably a takeaway from that too, is just because you did the last one like that, you're going to get the same issues. It's just they can be unique and things change very quickly, as I've learned sometimes, unfortunately, in the insurance world. Another great question: what is the minimum size of a project to implement a wrap program?
That's a really good question. So that depends on the type of project. If it's commercial or apartment construction, we generally see wraps start to quote above 30 or 40 million in hard costs. But if we're talking condos or townhomes or a large tract community, most of the time they go wrap, especially if it's a condo, because no general contractor or subcontractor can bring condo coverage. I should say no, but like 99% of policies exclude condo work. So with that, it really doesn't matter about the size of the project. It's more about, it's the type of project, it has to go wrap.
Yeah, and then on the condo projects, good luck with your architect. It's just serious fun times trying to figure out each architectural firm right now that has any clout in the industry has a different approach to how they're handling condos. Some will just not do them. Some will make you do some kind of, if you have a project that might become a condominium or even smells like it might get a conversion, they'll ask you to do a number of things, not least of which covenant that you won't do condos. So I think that led to one of my questions, just generally, Melody, is throughout the presentation, engaging with the architects as a vendor and interacting with them. Are there any tips for dealing with architectural issues and architectural firms during the, for your owners and contractors out there?
Yes, well, I think we could have a whole webinar on condo projects and architects' approaches. Again, that's the Wild West as well. I think, the biggest factor when it comes to condos is whether the architect's professional policy will provide condo coverage, whether the architect wants to load condo exposure in their annual program and kind of dilute the rest of their program and their limits in the event of a claim. There are some project-specific products out there, here we go again, that are project-specific professional policies that we found as solutions to help get everybody comfortable to have a project go. Because I feel like condos are a 4-letter word in Washington, and for good reason, right? I mean, it's tough, and the insurance costs are crazy because they got burned in the last condo cycle. So, but with just traditional projects outside of condo, I would say, making sure that if you're the owner or general contractor, making sure there's adequate limits to the project, as well as we always look at the limitation of liability. A lot of architects like to include that in their contract, and insurance carriers only want to pay what they're contractually obligated to pay. So if there's a limitation of liability, or LOL, and I'm not saying laugh out loud, if that's embedded in the contract and it doesn't have any verbiage saying insurance sits outside of that, then in a claim, their professional liability carrier will point to that LOL and say, hey, we're only responsible for that number, not for the limits carried. So,
yeah, and I can't, this is where it sort of looks like you're trying to drum in your own drum or whatever, but it seems like more often than not, when we have clients that come in and say, okay, we got this project going, everything's tight, here's all this AIA doc stack, and then maybe the architect's got their own custom contract. I mean, this is a place where you absolutely need your legal team to take a very close look at these insurance provisions. And if your legal team's any good, they're typically going to say, okay, let's send this over to the Melody, Olsons of the world to look at, because we have these issues and we're not sure we have exactly the right coverage. If you do not, you wake up kind of, the perils are endless, but one of the big pieces is your lender will look at you kind of funny and go, really? So it's important to really dig deep. And I think this was raised in one of the questions earlier, but like, what, do you do any consulting to potential clients? And I can just answer Melody's question for you. I mean, this is like one of the more imperative roles of any project is consulting with your insurance advisor to go through all these issues, not least of which, because the other advisors on your team are not insurance advisors, and it's tough. We get it. Paying policies and premiums that continue to, premiums for policies that continue to go up. It's always like the least favorite, but I'll tell you, it is much worse to be calling with some claim that you're not covered for and have your attorney tell you it doesn't look like you're going to have defense costs covered, because that is not good. So I would just say at every interval, if you're doing anything, not just construction, but commercial lease work, purchase and sale agreements, everything needs to be like, where are we at insurance wise? And what are the impacts to our existing policies? One of the questions I had also, Melody, before we sort of wrap things up here is, we talked about term of builder's risk policy. Let's say we go out and we get a policy that's 18 months because, or maybe more rarely a 2-year policy, but, because we're being proactive, but we really think our project's going to be 12 months, and then the project is really done. Full sign off CFO. I know this was just radical. Let's just throw it out there as a hypothetical. And you've got 6 months left. Is that it because you purchased a term and that term exists and there's no refunds or anything like that? Or is it something where you can kind of time that and anticipate a little bit of a return?
Good question. And I have to caveat it to say, it depends on the carrier and depends on how you negotiated it up front. Oftentimes, we'd like to see a pro rata kind of unearned premium returned back, especially if, we've completed early, because the policy ceases at certificate of occupancy, typically as the trigger. So if they're not on coverage, why did we pay for that? So yeah, I would say your broker is cognizant, pre-negotiates that up front and make sure that there's no minimum earned provisions in that specific quote to allow for that unearned premium to be returned.
Awesome. Well, thank you all for joining us today. Thank you, Melody and Propel, for their having you on, letting you join us. This is all going to be available again by a link, and Melody's contact information is here and will be emailed to you if you have further questions or need advising in this area. Melody's team is well versed in this, and obviously Propel does more than just Melody's segment, so she can get you in touch with somebody in a different department if that's necessary. So just a reminder, in January, you'll be seeing an email next week coming out on part 2 of this discussion, which is going to be the exciting world of cyber insurance, these phishing emails we all get, and what that means if one of your employees takes the deep dive and decides to give them all of your account information. Are you covered? What do you need? What should you know? And if nothing else, you'll learn what coverage you don't currently have that you should get out there and try and get. Melody, thanks for coming. Thank you everybody for joining us, and have a happy holidays.
Thanks for having me. Thanks, Mons.